LLC. Jake, good to have you with us. We've been talking a lot about contributing factors to this rally in stocks. We mentioned before the break NVIDIA, some of the other feeding into it, the data, central bank activity, but it's not the only contributing factors. Commodities in many ways have also, crude specifically, back to 80, 81, but still contained in terms of where we've been over the last year.
Yeah, that's absolutely right. And nice to be back, Ben. Thank you. I looked at the calendar. I was back, last time I was with you was just about a month ago. And it's really interesting to come and do a hit once a month because a lot has changed, but nothing's changed in many aspects, right? So back on May 22nd, we were talking about oil around $80 a barrel. And here we go. We're at oil around $80 a barrel. So that sideways consolidation, as you were just outlining, is really important for traders to pay attention to. And boy, as I'm looking at equities hitting all-time highs, you're right. I'm craving some consolidation to let me know that these levels are sustainable. Because I see price action like we've seen in NVIDIA and NASDAQ as we're looking at tech, and I get a little weak in the knees. Now, the move that we recently just saw in oil was about a big rally. We had sold off early in the beginning of the month and came back up to $80 a barrel, $81 a barrel. Now, that just moved us back into a consolidation phase. And so this rally in energy right now is not making me weak in the knees. But boy, when I looked at stocks, you're looking for consolidation soon.
Yeah, consolidation, contained, different words of describing the same thing, right? Price activity that's more overlapping and rotational, sideways developing rather than that vertical kind of high conviction type trade that we're seeing as you break out of like what we're seeing in the indices. And I think it's important to be able to identify the two phases so you have realistic expectations of what you should be looking for in terms of the day's session, right? But also expectations in terms of how you should approach it. You got to approach a high conviction trade to the upside a little bit differently than you do a sideways trade. You can be a bit more patient and wait for your price when it's consolidating. But okay, so price hasn't changed, right? Still hanging out around 80, 81. But Jake, what has changed?
I think what has changed recently is the chatter around market expectations of Fed cuts and interest rate policy. Of course, that's been the driving narrative for a long time now. And actually, OPEC and the IEA are constructive on demand going forward. I don't know. I agree with Sal Gilberti, who's our CEO and founder. He thinks oil goes back to 50 before it gets to 100. And I just see that we have capacity in the United States. We have supplies. I think oil is going to experience some downside pressure. That, of course, is against a backdrop of this energy transition that we continue to monitor closely. And we were talking about copper last time I was on. Copper has also pulled back recently. That is a change from our last conversation. But I would just point to the fact that the underlying story in copper is this transition to EVs and the electrical transition that we see that is necessary, not just for the quote unquote green economy, but also for the electrical computing necessities of AI. And so I think that what you have is a long-term story for copper that is fundamentally supportive. That could put pressure on crude oil prices, as we look to the intermediate 5-10 year term. So, I expect volatility in energy as you go through this transition. I just think that there's enough supply, there's enough capacity in the United States, and that's going to put overhead pressure on crude oil.
Well, I like kind of bringing crude oil and copper together in that discussion, right? Because they tie directly into that industrial economic kind of success or lack thereof narrative. Okay, so in terms of copper, buy the dip. In terms of crude, it looks like sell the rally, to your point, as you just mentioned there, and I see in your notes. How about grains, Jake?
Yeah, grains are very interesting. When we're looking at inflation and what's happened with inflation recently over the last, call it 2 years, food prices coming down has really helped with that inflation narrative. And I think that we are looking at a potential for grain prices to find that supportive consolidation range here, maybe another 5-10% downside on the major, corn, soybeans, wheat, et cetera. But once you see that support around a cost of production, and that's key when you're looking at the grains, is that they usually trade at or near the cost of production when there is plenty of grains available. They seldom dip below that level. Okay, and so as you find support in grain prices, we believe, around the autumn here, coinciding with the U.S. harvest, that should be a signal that there's risk for inflation on the upside. And that's where you have to be really careful. And I think the Fed is smart to be patient here in lowering rates, because the food prices coming down has really done a lot of the inflation work for the Fed. So pay close attention to that.
The idea there being that we do see grain prices discounted oftentimes, but only a certain amount, right? To a certain extent, will that be the case? Talk to us a little bit about gold. You see 2,300, Jake, as support, and you're not making as big of a deal out of the PBOC not buying, adding to their gold purchases last month as others are.
No, I don't see that as a red flag for gold, mostly because I see structural issues for geopolitics and the dollar reserve system in general. And last month I mentioned that, look, we're in a pot of water. It's not boiling yet, but countries are having conversations about limiting their dollar reserves and doing more business in other forms of currency, and gold or Bitcoin, those types of currencies, if you want to call them currencies, are good places to potentially store your wealth as you look for something to transact in global with global currencies. And so I don't see China not buying last month or adding to their gold reserves as a big red flag. China, by the way, paying attention to the ag commodities, they are very, very smart traders. Okay, and so with gold crossing over 2024, that was probably a signal to them. Hey, hold on, let's wait for a dip situation here before we increase reserves in gold again. So I'm not worried about that. I think the long-term story for gold is extremely bullish, and the other side of that is the long-term story for the dollar. Dollar bulls beware.
Yeah, we've been talking quite a bit about gold, and just kind of taking a look at this chart, if we could pull this up. This is exactly what I was just talking about in terms of the NASDAQ, right? Sideways consolidation at this level, not necessarily what the bulls want to see. They want it just to continue ripping higher like what we saw in April into the beginning of May, but it's tough to sustain that kind of momentum. And then establishing value, though, that again, it just sort of solidifies this working assumption. The value continues to move higher, and then you can kind of recalibrate and reestablish trades, oftentimes looking to add to your position at the lower extreme of this range and shave some off at the upper extreme while still holding on to that core long based on this longer term position here playing out. Jake, lastly, yields. I mean, kind of getting back to, as I brought you in, right, contributing to this rally, the 10-year back down below 4.25. I mean, I feel like this has helped quite a bit.
Yeah, it absolutely has. And, interest rate cuts, at the end of the day, who really needs them? I mean, at the beginning of the year, we were looking for 5 to 6 cuts. We were supposed to have 3 by this time of the year, and yet stocks are at all-time highs. Yeah. So equity traders don't actually need Fed cuts. I would suggest that bond bulls need rate cuts because banks are looking at some losses holding their paper, and certainly anybody that's was holding the 10-year treasury going into the year has lost money. So I think that the bond market needs the cuts. Equity markets don't need the cuts. And one final point, Ben, because I love this conversation about ranges in trading. It's easier to trade when prices are in a clear trend. We know that. It's easier to make money in those situations. However, just as you laid out, when you're in these consolidation phases where you're establishing value, allocators, not necessarily traders and swing traders, allocators will take that opportunity to build positions. Yeah. And I think you see that happening across the board in gold. I believe you see that happening in grains as well. And I do believe that the bullish story for commodities in this decade is not over. And so this is perhaps a time to look to allocate.
Yeah, consolidation in many ways, one could argue, is an accumulation phase. And I'd agree with you. And we were actually just talking about the Russell, right? Some of those small caps. We need to see lower rates to help them benefit a little bit. And definitely this rate environment discussion, we could continue it for quite some time here, Jake. But it all does feed into what we've seen in terms of stocks rallying and rates coming off. I feel like at the pace that they have has really been acceptable. And the fact that we haven't seen that talk of rate hikes is off the table, it feels like, for quite off the table right now, is also helping as well. Jake, appreciate you joining us. Jake Hanley, Managing Director, Portfolio Strategist at Teucrium Trading. Thanks to you, Jake.